Okay, folks, welcome back. I appreciate your patience over the last day. Still have a couple things I got to do housekeeping-wise, and I appreciate your patience in allowing me to do that. The current economic calendar for today, obviously we have a late start today, and we're looking at crude oil inventories at 11 o'clock. So we got about 40 minutes, 45 minutes or so until that number is released. That should affect CAD as well. So we're going to be observing dollar versus the Canadian dollar. And we'll go over that in a few moments. But for now, let's go take a look at what's already transpired and what may be unfolding for the remainder of the day. All right, you should be seeing the dollar index. Okay, and I'm going to, and yes, I'm recording. Thank you for the reminder. I'm going to put your questions tab over. Okay, and I saw your question before I clicked over. The reason why I don't look at low impact news is because I don't have that much influence. I don't believe it has that much influence over the type of magnitude of move I'm looking for. It's either going to be a medium impact or a high impact news event. That's usually what's used to mask the manipulation that's seen in price action. All right, so we have the dollar index, okay, and we moved above these highs. We were aiming for that as well. We moved rather aggressively yesterday through it. Came up here and hit the bottom of the bearish order block, which is the last bodied candle. Notice that we're not using this candle here. It's a down candle with a small little lower close. And this up candle here isn't the highest one either. It's this one. Even though it has a little bit of a wick on it, we're using the butt end of that and the low. So there's a fair value gap in between. Let me zoom in on that. Just remember the folks that are trying to watch this on their iPhone 4, where you're looking at a matchbox size screen. I don't know why you would watch that there. But the opening and the low on this, the low comes in at 98.09. And the opening is 98.13. So between 98.13 and 98.09, that's where the fair value gap is. And if you go over to see what today's high is, today's high comes in at 98.12. So it was just one pip short away from the opening on that bearish order block relative to the daily chart. And it's not unreasonable to expect some measure of retracement or of a pause in here because we broke through an old high back here on the daily chart, so it's normal for it to do at least a one-day down to constitute a retracement. Now, it can be forming a high. We don't ever know that. That's some of the things that I get questioned a lot. You know, how do I know if it's going to do this or that? I don't try to pick tops, especially when the market's been primarily bullish. And my thought process is this: if it's retraced this far up above this high, I still think that we're going to probably reach up above that 98.55, the 98.60 level. And then ultimately, I think we're ultimately going to go higher, really. I mean, that's just the bottom line. I think we're going higher. We're getting ready to go into November where the U.S. elections are going to be a lot more catalyst than they have been thus far. It's getting really dirty, a lot of mudslinging and really just disgusting things being mentioned. The government's really trying to do whatever they can to keep Donald Trump from being elected. Because they know he's going to be a rebel. He's going to be, he's going to upset everything. And he's not even really probably going to serve the American public the correct way either. So there's a lot of uncertainty with him. But I would still pick him over Hillary. And that's just it. Hillary's still the establishment. Nothing's going to change with her. Trump may bring all kinds of change, but it may be also unwelcome change. And that's going to cause a lot of uncertainty. A lot of things are going to go off. And people are going to be running to the dollar as a means of flight to quality, because that's the way I interpret. That's the way I see it. I think that's what this has all been down here, all accumulation, and I think they're going to make a run through that dollar mark up here. Okay, and we're looking for 102 to 107 on a blow off, and if we get to those levels, we'll have to revisit and see if we're going any higher. But I do think that we're aiming for parity still on cable. We're still looking for parity on the fiber Euro USD as well. But that takes some time to get out, to work that out. So while they're long-term macro views on price, we still have to look at the lower time frames. You need to find some objectives and trade within the ranges that are currently being made available to us. So classic support resistance, guys, are going to be looking at these highs here. And on this candle here, the high comes in at 97.56. So we're looking for retail to be expecting support to come down in around that 97.60 to 97.55 level. And for folks that look at the buys of candles like we do, they're going to be looking at 97.40s, okay, for support on dollar. Me personally, I don't want to see anything. Get this out of my way. I don't want to see anything below this candle here. I don't want to see that. Okay, it can reach down into that and hit that. Well, not so much that. Let's do this. I like that level, and the reason why I did that is because there's a lot of work around that level. It means the close on this candle here, the opening on this candle here, the close on this candle here, the open on this candle here. So there's a lot of work around it, and it's also the middle of this big down candle, which is a bullish order block. So this is the mean threshold. So it can come down and touch 97.60 to 97.57. If it goes down through that, obviously it's going to want to clear out these equal lows where there's liquidity pool resting for sell stops. I don't personally believe that it needs to go down there. If it does, it's going to have to show me a willingness to quickly get away from it, not spend a lot of time below these lows, because if it does, it's going to want to come down here and close in this. And that puts us around that 97.30 level. And while that still may be necessary for longer term, I'd rather not do that, because we've already swept out these lows here. Right here, we've already cleaned those out. We've paused. We haven't moved away from that. Now we're dipping lower. So if we get below this wick in here and get down to this mean threshold of this down candle, excuse me, that should be, in my opinion, should be all that should be necessary for a retracement. So 97.60 to 97.55, if it spikes through it without closing, that's acceptable. And then we would make a run on these equal highs. I like how they left that up there real nice. It looks like a real solid retail resistance level. So folks are going to see that as safe resistance, or 98.10 is a near-term resistance level. So on your charts, you want to highlight $98.10 to $98.12. There's buy stops resting just above those highs, and it's been methodical about the way they're dropping it down. So again, all eyes are on that 97.55 to 97.60 level. Should we lose that level again, you're going to be paying attention to this liquidity pool resting below these equal lows down here. If we run through that, the last line of defense for near-term bullishness is going to be this bullish order block, which is a down candle prior to this up move here. So we have a little bit of a liquidity void here and a fair value gap between the opening on this down candle and its high. So be mindful of that. And this is a 30-minute chart for your notes. Just make sure you're aware of that. Euro pound. I still think we're probably going to make a run up in here. I'm not sure how we're going to do that in regards to manipulation through euro and cable, but I do suspect that's probably what's going to happen in here. Euro traded down into its bullish order block in here, and we've since come back, and now we're retesting the opening of that down candle or bullish order block. The mean threshold for it, and this is a daily chart again, so keep that in mind. We've pierced equilibrium, didn't close through it, and it'll be interesting to see what we do in regards to today's close. Do we hold on to it here, or we press up even higher? And I'll still maintain the thought process that we're going to want to go below these lows over here. I almost did it today with its willingness to want to reach down initially, but it didn't have any continuation from the initial move lower. Near-term liquidity pool rests obviously above the intraday high here, and then we have these highs as well. So we're going to be watching this. Right in there. And it also takes us right up into bearish order block. And again, this is a 15-minute time frame. So using the low up to the opening, That's a fair value gap. So we can watch that as potential upside objectives. The question is, okay, let's say we're looking at price right now. And this is just for a means of teaching, exercising when you're looking at the charts. And I'm not giving you anything in between videos or suggestions. If you're watching price like this and price was down here in close proximity to this down candle, you can do a paper trade, okay? You can do a paper trade and say, okay, hypothetically, I'm going to say I'm going to buy. If you have access to the demo account that you're messing around with and practicing, you can do a long in here, okay, and then use the stop below that candle's low. And you would be reaching for this objective here. So let's assume for a moment the open is at 1032, the high is at 1036, and as price was trading around in here, you could say, okay, look, I'm going to hypothetically say I think it's going to go higher. Okay. Now the question is if you think it's going to go higher, and to buy it, you're going to add 3 pips to whatever that market price is. So like right now, it would be 1040. If you bought it right now, your fill will be 1040. Now I'm not going to do it because my account's hooked to the MyFX book, and I'm not trying to mess it up. But you would add 3 pips to it, so you'd be at long at 1040. The question is, would this be a viable exercise to do for a demo or just paper trade? The reason why I'm asking that is how much movement is there between where we're identifying a liquidity pool and where you would be taking a long at for practice. Exactly. It's not much room at all. You're only looking at about 10 pips or so. Okay. So if you factor spread in for that, even though we can anticipate where the market may reach up to, it doesn't give us enough room to frame out a practice trade. And that's why you need to be looking at the higher time frame charts, because it gives you a lot more range in terms of where the market may go and where it's at currently. And if it's above us, where the market may be reaching for, it's got to give us at least, in my opinion, the best scenarios are 40 pips of range. If you can't find something that offers 40 pips, move aside. Just paper trade it and say, okay, just for practice sake and price reading, I think it's going to go up there, but I can't be trading it, but I want to practice my anticipatory skills. And you just watch and see how many times this unfolds. And the more time you do it, the more time you spend in front of the charts with higher time frame charts. Like again, this is a 15-minute time frame, so it's not much in terms of movement that would be expected. That's not all that it could do. I mean, it can obviously go up here and clear up a little bit of this as well, but that puts us around 1060. That would give 20 pips, but you know, being this late in the day and the only thing that's coming out now is inventory on crude oil, I don't think it's going to be that much of a catalyst for upside for euro dollar in that regard. But that's all you're doing is when you get in the charts, you look for those opportunities to find out where the price may reach for and where we are in terms of current price action. And here, we're just going to watch and see what that does today, going into London close. Cable. Okay, cable is just slowly working its way down in here to come down below this low. I think if we go below this low, normal expectations would be for the floor to drop out. And I think they may end up surprising us. I think what will happen is they'll take it below the low by a little bit, maybe 30, 40 pips. We could even spike down as much as 100 pips below it. But I wouldn't be surprised if we don't aggressively come back off of that and try to wipe out those individuals that are assuming shorts all through here. Then still longer term going into to March of 2017, I still think we're going to be down into the 110s on cable across everybody's platform. I think that'll be the price everybody's looking at, and maybe even lower than that. But I'm watching the low that was formed here on the quote-unquote flash crash of British Pound USD. I think that we're going to probably come down here and probe that low and see if there's anything in terms of willingness to be a seller below it. And if we do go below it, you know, I think after then we'll probably see a measurable retracement, and probably be, you know, one that would be, you know, respectable. In other words, it's going to squeeze a lot of shorts, because there's a lot of folks in here short, and new shorts are being established right now. So they understand that everyone's expectation on this market is to take out this low. So if they take it below that, even traders that want to trade on a breakout below that low, they will be short. And those individuals that have been short in here, they're going to put their stop loss above significant short-term highs, and then they'll run through those. And if they're running those buy stops out, they'll be selling into all those runs on shorts to establish new shorts, in my opinion, for longer-term 110s on pound dollar. Does that make sense? I'm not saying you have to agree with what I'm saying. I'm saying, does it make sense for what I'm describing? Right, exactly. Okay. I just don't see this thing bottoming out like this. I think we're going to make one more run below the low, and we'll see what we see there. Once we get through that, unless we get some wild continuation lower, I think it's safe to be real. If you're trading British pound, you really want to dial back your leverage and give yourself a little bit more room. If you're used to trading with like a 30 pip stop, I'd be using a 60 pip stop and use the same gearing. Use the same gearing in terms of your leveraging, but don't try to get in there with a 10 pip stop on cable right now, because there's so many reasons for it to spike up and down and take you out prematurely, and this is going to frustrate you. So give yourself a little bit more room and wider stop, and you can still potentially make a lot of pips and not necessarily need a really small tight stop. Today we've been rather lethargic and quiet. It hasn't been really doing much at all for cable, and we had a little bit. What is this here? Let me ask you before I talk about it. For those that are watching, even in the recording, you should already know what this is. Liquidity void. Yep, very good. So if we identify that, and price has moved up aggressively in here, okay, we have that exposed range right there. So while it doesn't quickly, immediately come right back down there and fill it in, it takes some time. It grinds down lower. Notice when this low here came down into this void right here, this portion of that void is still exposed. Do you get that? This portion is still only been offered on the buy side. Okay, they've only seen price going through it up. So just like that paint analogy, okay, this portion of the canvas had to be filled in on the downstroke. Price was delivered on the up move here, and it was delivered on the down move here. Okay, so the last video I did, do you see how that the distribution of price was exhibited here? It was offered on the up move, and then it was closed in again with the down move. Perfect delivery of price is going to have both price offered when it's trading up through it and then down through it. Okay, and that's efficient price delivery. Anything apart from that, you're going to have pockets or little holes or gaps in price, and then the market will invariably want to go back to those areas and fill that in. And that's why I'm saying you don't necessarily have to have the trading bias like everyone's insisting. Give me the bias for today. You don't need that. If you understand what you're trading and what time frame you're looking at, you can trade it with a great deal of precision, just understanding what fair value is and where are the gaps or the ranges you're trading in. I mean, everyone knows that this move here from this low up to this high, what would that be called? Now think in terms of what was taught to you in September. What's this called? It's a specific, exactly, impulse price swing. Okay, so we have an impulse price swing. Then we have that, we're going to see price want to come back down into it. Okay, especially if we have a void like we have here. Look at the responsiveness on price when it got back down into where price broke away from the bodies here, right in here. Some people would have a line right on the top of the wick. We don't look at the wicks because it's the thinnest portion of the volume. The bodies of the candles, when price blows through that, that's where you want to have your line. So when price comes back down to it, it's going to want to reach into that level right there, and it does just by a little bit. The low comes in at 121.36 and it's 121.40. So notice how it went down far enough to allow the spread to be factored at buying essentially at that same level. Sensitivity can begin at the wick back here, yes, it can. But we prefer rather seeing it come down into the bodies. Sometimes if you're demanding that it gets down to that level there, you're going to see some trades that escape you, and that's going to happen. There's no way around it. But if you're absolutely 100% gung-ho about you have to be in that trade, you're going to use the wick plus the spread, and then you got to allow some room for your protective stop loss as well. Notice the bodies of the candles over here. Look at what they were respecting. They had sensitivity really around the wick, but price ultimately came down to where the bodies are on here. Okay, so that's why I have that level there. It looks as though, I mean, we left a really nice area up here, 123.40 to 123.30 in that range. So there's a lot of buy stops resting there. I'm not saying we're going to go run right up there right now and get them, but here's a scenario I have in mind. When I was looking at the daily chart, I was expecting, if we look at this move, here's your low, right in here. If we trade down and we take out this low, and say we move around, I don't know, maybe down to 2060 or 2050 to really wash out that low, get people really juiced up about wanting to see it break down, and it very well may. It could keep going down for a long time and go straight to 110 and do it in a day, and then there you go, you missed one more opportunity because it moved too fast. But assume for a moment it trades down there and gets below the 120, 60, 120, 50 level, and then we start trading back up, and we get back above this high here, this low, to start making higher highs. I think personally they will make a run on the liquidity above here, because think about what that'll do. That'll price in about 1,300 pips for a move down to the 110s. Whereas if they just let it run from here, they already have people already on the ride, because we haven't had any real runs on stops. Notice that? Since we came up here and just poked above this short-term high here, right above that high here, we have all this down movement. So people are already net short and they're making money. But now they put the brakes on it. Now we're consolidating. So while it would be easy to expect price to keep going lower, if it's going to go lower of any significance below that low here, why would the bank allow everyone that's already on board short to get a free ride? That's not their MO. Their MO is okay, they already believe that it's going to go lower. Everybody's expecting British pound to go down to 0. So they're short. And then we had this move here from London. It's slowly grinding higher, 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 higher. And ultimately, they may not have enough buy stops in place in here. Maybe there's a lot of people that are just too afraid to get short. That's what I'm weighing out. That's what I'm saying. I'd rather see it come down, take this low out here, and then do a real quick aggressive run up to just get above these highs. I would not be fearful of being short still, even with being a witness of seeing that, because I would understand that they're knocking out everyone that's already short here. That would clear out the entire board. And by taking these stops out here, these buy stops at the market become orders to buy. And if they're going to be assuming short positions and we're ultimately going down to 110 or lower, that would be a really optimal entry for being short, because it prices in a range of 1,300 potential pips on the downside. In here, while it still can roll over and go lower and break through the low and ultimately keep going down, to me, it wouldn't make that much sense, because outside of this short-term little equal highs in here, that's all we saw price move above. But notice we haven't seen any real willingness to break down. There's no willingness to see it go lower. So this is not a raid. I was being asked if was this already rated. No, this is just a retest. And that allows the thought process of that this is now resistance, so therefore that allows, it's engineering, that's how they do it. When you have a high and it comes right back and just touches it, or maybe it falls by 1 pip or goes above about 2 or 3 pips, we want to see 10 pips or 20 pips sweep above it. See, what they're doing is that they're giving you, and a retail trader rather, the premise that this looks like what? I mean, if you ask anybody, if you showed them that chart right there, they're going to tell you it's hitting resistance and then say, okay, get short. Price is going to go down, okay, and now all of a sudden they think they're smart. Now they're a genius. They can't be wrong. They're going to make all kinds of money. The low is going to break out. And then all of a sudden you get this. So anyone that's short way earlier, okay, this is the most logical area for them to want to trail their stop loss, unless they're ultra really aggressive and they don't want to lose a penny. You know, they may have their stop above this high here or above these little short-term highs in here that would have been viewed as a short-term resistance level. And they've already cleaned those guys out. And they haven't really moved price. They've kept it sideways. So I think what they're doing is they're giving folks a chance to trail their stop loss down, because apart from going above these highs in here, I don't think it's good for the market to go lower near term if they go much above these highs. Okay, so above these equal highs, let me draw that out because I know sometimes. Okay, right above these highs in here, that's where I think the buy stops are. So if they make a run up that point here, and it may not happen, it doesn't have to happen, but to me it would be logical for that to happen after it takes this low out, because what they'll do is they'll trip people in short. Okay, they're going to be knocking people into the marketplace initially first, going short, then aggressively running up on the trailed buy stops that would be above whatever highs are in here, and ultimately aiming for the buy stops here. Now, to do that, they would be establishing shorts at every time the new highs would be violated. They'd sell into it, sell into it, sell into it, and they would ultimately aim for the biggest portion right up in here. To knock out those individuals prematurely now without taking out the low, okay, the only participants that have sell stops, buy stops on their short positions above these highs here are the folks that have already sold over here. And I think I was the only one that went short that I know of, okay, that was willing to do anything with it because of all the fear that was around it. So this is the only logical area where the stops would be at right now. There's not enough new sellers in here yet. Everyone was scared. They all watched the reaction, and they've been reading Reuters. They've been watching, CNBC. Everyone's got their opinion of why the cable went down. We've explained why it went down. It was the central bank repricing to the 120 level. But if you put that aside for a moment, just look at what's been going on here. I mean, the market, that's scary to watch it go down 800 pips in 3 minutes. That's dramatic. So it puts people on the brakes, okay, and they're sitting on the sidelines and they're watching cable. They all have a Twitter opinion. They all have a Facebook demo account, that's linked up to something, and they're going to make 1,000 pips. But really, most traders are on the fence about what they want to do with cable. They're sidelined. So even if this thing goes lower, think about it. Why would the bank make a run down to 110 from these levels right now when they don't really have enough participants in? Like where are the buyers at? They have to have buyers in. So what they're going to do is they're going to engineer. To get those stops, okay, to sell into it, okay, because smart money has to have buyers. The way they get those buyers is they attack buyers above current price action. So if the price drops any farther from here, okay, the only the only buy stops that are in the marketplace are those buy stops that are above here. Small little pool of buy stops above this high here, some buy stops above here, and then whatever would be residing here. So here's my question, and I want you to really think about this, because this is what makes. Yeah, I just stopped talking. I'm not continuously talking. As much as I'd like to talk a lot, I'm not always talking. So apart from these equal highs, yes, the market has drifted lower. Okay, the market has drifted lower, but how much are we seeing in terms of short selling? There's not been a whole great deal of opportunity outside of this run here and then the retracement. So the bulk of where I believe the buy stops reside are above this high here and above these equal highs. Maybe there's been a small measurable amount of liquidity that's been trailed down to here from those individuals that sold over here. Okay, that's fine and great, but that's not enough. It's not enough to establish more selling, because the banks are greedy. They're going to want to be positioning more shorts. So it lends well to the idea that if we do just drop down here, okay, they know that the folks that are going to expect this low to break, they think it's going to go down a lot more too, these individuals that are short. So they're going to be willing to hold on to their short position. They may give up a small piece of the pie, they being smart money. They may give up a small piece of the pie by letting price go down below this low, okay, and then allow these folks that are short up here to trail their stop loss to here or whatever would be here, okay, and ultimately the longer term bears leaving their stop up here, they won't be safe either, because when they drop it down, all of a sudden new shorts will be in, and the new shorts will put their stop above whatever recent high will form, and then when they reprice higher, every time it goes through these positions, short-term highs, those buy stops will allow the bank to go right in there and establish new shorts. And then they'll allow price to run down and go to the 110 level. Does that make sense? I mean, that's just the scenario I'm seeing. And it's not the only one that could happen, but that, given what we're looking at here, that's what I would personally and reasonably expect. And that's why I believe we're going to go down below this low before we come up here first, because it wouldn't make any sense to come up here yet. There's not enough buy stops up here yet. And when we talk about open float later in this mentorship, you'll understand why. But I'm just giving you the foundations of why I believe that we're most likely going to take this low out before we come up here, because there's got to be more buy stops occurring and forming above the current market action before they send price lower. That's the first lesson I taught on Baby Piss in 2010. I said that you want to be looking for price to come back to a previous high, run it out. And if you're bearish, that's the best selling scenario, because they ran the stops. They only went up there to take those buy stops out and convert them to liquidity for their selling. And if the market goes down below a previous low and you're bullish, they have only repriced below that low to exercise those sell stops to induce selling liquidity, so that way they can buy into those sell stops. And then you'll see price expand and go in its uptrend. It's really important, that's why I gave it to you the first month, what to focus on, because if you, every single day when you're looking at price action, you look at these reference points, you can't not understand what price is going to do. As a result, it will be by default. You're going to see it. You're going to understand why they're doing what they're doing, and you'll anticipate it. So right now, that's why we're consolidating. It's allowing folks to build more expectation that this low is going to take its run out, and more buy stops will form above these reference points that I've just noted here. So again, the least resistance is below this low, but if we break below that low, I'm going to be really inclined to believe that they're going to make a run or squeeze on those positions that are short. So you're going to be focusing on your short-term highs with the expectation that they may even run all the way up here. And now think about this. Let's say that happens. Say that the British pound blows out this low and then screams up, okay, for a week and takes out the stops above here. Everyone's going to think that we made the low. Wouldn't you expect that? If that's what happens, say we take out the low that was formed on the 11th of October, and then we scream all the way up over a series of several days, and we go up back into the 123.40s. Everybody's going to assume that that was the low in the British pound. when in fact my expectations would be they only came up there to knock them out, and then we're going to see the 110s. So that's the scenario I'm playing out, and if I had control over the price, that's exactly what I would do. That's exactly what I would do. I would consolidate this thing all day today, okay? I would send it up tomorrow in London and then sell off aggressively and make a straight run right down into these lows. That's what I would personally do if I had control over price. And I would know that there'd be all kinds of willingness to be a seller for the masses out there, and I could buy that up, and I could make a run from 120.70 all the way up to 123.40. And then I'll establish my long-term shorts here and then let it unfold down into 110s over the next couple months. That's what I would do. So, no, I don't have control over price. I'm working on it, though. I am working on that. That's the next mentorship. If I ever establish control over price, that's the next time we do a mentorship. Until then, we ain't having one. So